Right now, the market is flashing two completely contradictory signals. You've got a record-breaking AI boom on one side and a consumer on the verge of collapse on the other. The only trade that really matters is understanding this divergence.
So let's just break this down. The NASDAQ is printing new all-time highs, while at the same time auto loan delinquencies are spiking to levels we haven't seen since the 2008 financial crisis. Look, this isn't just noise. This is a massive signal of a fractured market, and that presents both extreme risk and, some very targeted opportunity.
Okay, first up, let's talk about the bull case. The entire argument for stocks to keep grinding higher rests on these big, top-down macro tailwinds.
The bullish argument is pretty straightforward, right? You get a moderating CPI print for September, and that's fueling all this talk about Fed rate cuts. You combine that with corporate profits that are, frankly, still very strong, and you've got the classic recipe for a risk-on environment.
This quote really gets to the heart of it. Strong aggregate earnings are the mother's milk of stocks. As long as those profits hold up, the bullish thesis remains intact, no matter what cracks might be forming somewhere else.
But now, let's look at the other side of the trade, the bear case. Because while that macro picture looks pretty good from 30,000 feet, down on the ground, the foundation is definitely cracking. And the stress is really concentrated in two key areas, the American consumer and some serious geopolitical risk.
And this number, this is a huge red flag. We're talking about credit card delinquencies. 90 days or more past due, they have tripled since 2021. That's a 15-year high. This is not some minor crack. This is a seismic shift in the financial health of the consumer.
This chart here really shows you the depth of the problem. 2/3 of Americans are living paycheck to paycheck. And what's even more concerning is that a full quarter, 1 out of every 4 people, are now using buy now, pay later services for essentials, like groceries. That is a clear, unambiguous sign of an unhealthy consumer.
But this is the most alarming data point of all. Auto loan defaults are now getting dangerously close to the 5.3% peak we saw during the 2008 financial crisis. You just can't ignore that level of systemic stress. It's real, and it's accelerating.
And on top of all that consumer weakness, you have this wall of event-driven risk building up. A potential 157% tariff on Chinese goods, stalled trade talks with Canada, a looming government shutdown, and a Supreme Court hearing on tariffs. Any single one of these could be the catalyst for a major market move.
So how do we square this? How do you resolve these two completely opposing stories? The bull case and the bear case can't both be right. Or can they? The synthesis here, the way to make sense of it all, is to see it as a K-shaped economy.
A K-shaped recovery is exactly what it sounds like. It's when one part of the economy is just blasting off, heading up and to the right, while another part is falling off a cliff. It's a market of haves and have-nots, and the data is showing that this gap is getting wider by the day.
And here it is, laid out plain and simple. The upper arm of this K is mega-cap tech, and it's being fueled by the AI boom. The lower arm? That's the broad consumer base and the regional banks that lend to them. These two parts of the market are heading in completely opposite directions. And if you need the data to prove the thesis, well, here it is. Projections show total U.S. GDP growth coming in around $430 billion. Now look at the second bar. Of that, $400 billion, that's over 90%, is expected to come from the AI spending of just 5 mega-cap tech companies. The takeaway here is absolutely crucial. The rest of the U.S. economy is basically stagnant.
Now, for the mandatory disclaimer before we discuss strategy, this content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, so how do you trade a market that's literally splitting in two? The optimal strategy is to actually play both sides of the K, but you have to use structures that clearly define your risk from the start.
So this table lays out 4 potential strategies. Using spreads is smart because it defines your max loss, which is key in a volatile market. To play the lower arm, you could look at put spreads on auto retailers like CarMax or on consumer discretionary ETFs. You could also hedge with some protective puts on regional bank ETFs like KRE. For the upper arm, call spreads on tech, like the QQQ, lets you target that continued strength. And a sort of derivative play is call spreads on discount retailers, like Dollar General, which actually benefit as consumers trade down.
But look, none of these ideas work without discipline. So here's the framework. 1. Define which arm of the K you are targeting.
upper or lower. 2. Always use risk-defined structures like spreads to cap your maximum loss. 3. Start with smaller, starter-sized positions. And 4, and this is maybe the most important, know your invalidation level, the exact point where your thesis is proven wrong and you get out.
All right, to wrap this up, let's focus on the key catalysts that are on the calendar. These are the events that will either confirm this whole K-shaped thesis or, completely invalidate it.
You're going to want to circle these dates. November 1st is the deadline for those potential China tariffs. November 5th, the Supreme Court hears a case on tariff authority, and then in mid-November, we have another potential government shutdown deadline. The outcomes of these events are going to drive some major volatility.
So this all leaves us with a final question. The data shows a market that is fundamentally split down the middle. So where do you stand? Do you position for the tech boom, for the consumer busts, or does this wall of worry just keep you on the sidelines altogether?
And one last critical disclaimer, not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.